Hello, everyone, and welcome back to Boss Economic World, the only show that peels back the jargon-filled onion of global finance to find the juicy, sometimes tear-jerking, truth at its core. Today is November 11th, 2025. For most of you, that probably means your online shopping carts are overflowing and your bank accounts are crying. It's Singles' Day, the world's biggest festival of consumerism, a day invented in China to celebrate, well, spending money. But while hundreds of millions of people were busy clicking by now on the latest gadgets and fashion, the biggest player in China wasn't adding to a shopping cart. It was trying to get the rest of the world to open a new line of credit. A line of credit written in bright red yuan. That's right. Just a couple of weeks ago, the People's Bank of China, or the PBOC, dropped its annual report. Now, I know what you're thinking, boss, an annual central bank report? That sounds about as exciting as watching paint dry. And normally, you'd be right. These documents are usually masterpieces of bureaucratic doublespeak, designed to be read by 10 people in the world, all of whom probably need a triple espresso just to get through the first page. But this one is different. Buried in the dense text is a declaration of intent, a strategic pivot so significant it's like watching a chess grandmaster suddenly decide to play poker. The headline? China is officially going all in on making the yuan a funding currency. Funding currency. Sounds boring, right? Wrong. This is the financial equivalent of a blockbuster movie trailer. What it means is that Beijing is no longer just content with you using their money to buy their stuff. Now, they want you to borrow their money to build your stuff, to pay your debts, to fund your future. They're rolling out the red carpet, not for tourists, but for debtors. And they've got a killer sales pitch: our loans are on sale. So today, we're going to unpack this. Why is China turning into the world's new easy money lender? What are these Panda Bonds and dim sum bonds they keep talking about? And most importantly, is this the beginning of the end for the US dollar's reign, or is it just a clever marketing gimmick with a whole lot of fine print? Let's dig in. To understand what's happening, you need to understand the single most important rule in finance: there's no such thing as a free lunch. But sometimes, you can find a really, really cheap one. Right now, the global economic cafeteria is serving two very different meals. On one side, you have Uncle Sam and his friends in Europe. To fight off the ghost of 2022's inflation, they cranked up interest rates. Borrowing dollars or euros has become expensive. Think of it as the organic, artisan, $1.25 a plate lunch. Then you have China. While the rest of the world was battling inflation, China was wrestling with its own ghost, deflation. The economy has been sluggish, consumer prices are flat, and the property market, well, let's just say it's been in a prolonged state of meditation for years. To get things moving, the PBOC has done the opposite of the US Federal. It has kept interest rates low. Borrowing yuan is cheap. It's the all-you-can-eat buffet for $9.99. Let's put some numbers on it, because that's what we do here. As of today, in late 2025, a 10-year US Treasury bond might yield you around 4.5%. To borrow money, you're paying at least that, probably more. Now look at a 10-year Chinese government bond. It's chilling at around 2.5%. If you're a finance minister in, say, Kenya, or the CFO of a multinational corporation in Germany, you do the math. You need to borrow $1 billion to build a new port or a new factory. Borrow in dollars, and the interest alone costs you over $45 million a year. Borrow that same equivalent amount in yuan, and it's closer to $25 million. That's a $20 million a year saving. For that kind of money, you'll not only learn to say xie, you might even get it tattooed. This, my friends, is the core of China's new strategy. They are weaponizing their low interest rates. The PBOC report wasn't a dry academic paper, it was an advertisement. The message is clear: the dollar is expensive. The yuan is cheap. The choice is yours. This is a huge shift. For years, the story of yuan internationalization was about trade. Please use our currency to buy our widgets. It was a slow, grinding process. Now, the strategy is about finance. It's more ambitious, it's faster, and it's much, much sexier to the people who run the world's money. As Xiao Jiaji over at Credit Agricole put it, China is broadening the yuan's usage for multiple purposes. That's banker speak for, we're not just a corner store anymore, we want to be the bank. So, how exactly does a country like Hungary or a company like, let's say, Ford, get its hands on all this cheap yuan? You can't just walk into a bank in Budapest and ask for a billion yuan loan. This is where Beijing's financial engineers have been working overtime, building a whole ecosystem of products. The PBOC report specifically mentioned a few key tools. Let's call it the Yuaniverse Toolkit. 1. Panda Bonds. This is the star of the show. A Panda Bond is when a foreign entity like the government of Egypt or a company like Mercedes-Benz issues a bond inside China, denominated in yuan, to raise money from Chinese investors. Think of it as a foreign band coming to play a concert in Shanghai for a local audience. The report notes that last year, 2024, saw a record surge in these. We're talking about a combined 1.4 trillion yuan in Panda and its sibling, dim sum bonds, issued to overseas entities. That's not pocket change. We've seen emerging markets like Hungary and Kazakhstan, and even developed nations corporations, flocking to this market. 2. Dim sum bonds. These are the older cousin of Panda Bonds. They are yuan-denominated bonds issued outside of mainland China, primarily in Hong Kong. They've been around for a while, but with the new push for cheap funding, they're getting a second wind. They help build up that crucial pool of yuan floating around outside of China's direct control, what financiers call the offshore yuan liquidity pool. 3. Direct yuan loans. This is the most straightforward tool. Chinese banks are increasingly being encouraged to lend directly in yuan to foreign companies and projects. The POX data is telling, outstanding commercial bank loans in yuan to offshore borrowers hit 2 trillion yuan at the end of 2024. That's up 14% in a single year. This is where you see the strategy connecting directly to China's other global ambition, the Belt and Road Initiative. That new port in Pakistan or railway in Kenya? Increasingly, the financing contracts are being written not in greenbacks, but in redbacks. For bilateral currency swaps, this one is a bit more technical, but it's the bedrock of the whole system. The PBOC has currency swap agreements with around 40 central banks, from South Korea to Turkey to Argentina. Think of it as a financial I've got your back. If a Turkish company needs yuan to pay a Chinese supplier, but only has Turkish lira, the Turkish central bank can go to the PBOC, swap some lira for yuan, and make the yuan available. The report highlighted that these swap lines are being tapped more and more, not just for emergencies, but for regular trade financing. It's like having a pre-approved credit line with your biggest supplier. Put it all together, and you're not just looking at a few isolated products. You're looking at the deliberate construction of a parallel financial plumbing system, one that allows money to flow around the world without ever touching the traditional, dollar-dominated pipes of New York and London. We're even seeing companies like the UK-based payment firm Ebury beefing up their China offices specifically to handle the boom in yuan settlement demand. The demand is real. Now, at this point in the story, the pro-China cheerleaders are popping the champagne and the dollar doomsayers are running for the hills, stockpiling gold and canned beans. But here at Boss Economic World, we always read the fine print. And the fine print on China's grand offer is written in invisible ink. Let's be clear-eyed. For all the progress, the yuan is still a minnow swimming in a dollar whale ocean. Challenge number 1, the golden cage of capital controls. This is the big one. The fundamental contradiction at the heart of China's ambition. How can you be a truly global, international currency if your home country has some of the strictest capital controls in the world? Getting money into China to buy Panda Bonds is getting easier. But what about getting your profits out? China's government maintains an iron grip on money leaving its borders. They do this to prevent capital flight and maintain financial stability. But it spooks foreign investors. It's like being invited to a fantastic party in a beautiful mansion. The food is great, the music is great. But the doors are guarded, and you're never quite sure if they'll let you leave when you want to. The US dollar, for all its faults, is like a public park. You can come and go as you please, 24/7. That freedom and predictability is the dollar's superpower. Until China is willing to give up that control and let the yuan trade completely freely, it will always be playing with a handicap. Challenge number 2, the trust deficit. Money is about trust. The world trusts the US dollar not just because of America's military or economic size, but because it trusts the institutions behind it, the independent Federal Reserve, the deep and transparent financial markets, and the rule of law. If you have a dispute over a dollar-denominated contract, you can go to a court in New York or London and expect a reasonably fair hearing. Can you say the same about Beijing? The PBOC is not independent, it answers to the Communist Party. The legal system is opaque and can be influenced by political considerations. What happens if your country has a political disagreement with China? Could your access to that cheap yuan funding suddenly be turned off? Could the rules of the game change overnight? For a global CFO, that kind of political risk is terrifying. Challenge number 3, the Hotel California risk. Remember our cheap lunch? The yuan is cheap to borrow now because Chinese interest rates are low. But what happens when China's economy finally recovers and the PBOC has to start raising rates to control its own inflation? Suddenly, your cheap yuan loan isn't so cheap anymore. Even worse, if the yuan strengthens against your home currency, the principal amount you have to pay back gets bigger and bigger. You could find yourself in a debt trap. You checked into the cheap yuan hotel, but you might find that you can never leave your debt. This is a classic emerging market currency trap, and it's a risk every borrower is weighing. Challenge number 4, the sheer scale of King Dollar. Let's end the reality check with some perspective. The PBOC report proudly noted the yuan's share of global trade finance hit 7.3% in September 2024, making it number 2. That's impressive. But what was the dollar's share? Around 84%. That 2 trillion yuan in offshore loans? Sounds massive. But total cross-border lending in US dollars is well over $50 trillion. The yuan is a growing force, no doubt. But it's like a promising rookie who just had a great game. The dollar is Michael Jordan in his prime. It's not even a competition yet. It's an exhibition match. So if the challenges are so huge, why is Beijing pushing so hard right now? The answer has less to do with economics and everything to do with geopolitics. The last decade has been a wake-up call for Beijing. They've watched the US use the dollar's dominance as a tool of foreign policy, a weapon, even. Washington can cut countries off from the global financial system with the stroke of a pen. It can freeze a central bank's dollar reserves, as it did with Russia. From Beijing's perspective, this is an existential threat. Their entire economic model is built on global trade, and that trade runs on dollar-denominated rails. What if one day, the US decides to sanction China in a major way? The push to internationalize the yuan, especially as a funding currency, is about building an escape hatch. It's about creating a Plan B financial system that is insulated from American political pressure. It's about creating a coalition of countries in Asia, the Middle East, Africa, and Latin America that are also tired of living under the dollar's thumb and are looking for an alternative. When Saudi Arabia starts discussing selling oil to China in yuan, when Brazil and China conduct trade directly in their own currencies, when a UK firm hires more staff to handle yuan payments, these aren't just isolated business decisions. They are small, but significant, tiles being laid in the foundation of a new, multipolar financial world. China isn't trying to kill the dollar. It's trying to build its own financial sphere of influence where the dollar is simply less relevant. The goal isn't to replace the king, but to become a powerful regional lord with its own loyal vassals. So, what's the takeaway from the POC's grand plan of 2025? Is the yuan going to be the world's reserve currency by 2030? No. Absolutely not. The structural hurdles of capital controls and trust are simply too high to overcome that quickly. But is this a fundamentally important shift in the global financial landscape? Yes. Absolutely. The move to promote the yuan as a funding currency is the most sophisticated and potentially most successful phase of China's internationalization strategy yet. By leveraging its current low interest rate environment, Beijing has found a compelling, market-driven reason for the world to borrow its currency. It's a strategy that plays to its strengths while simultaneously addressing its biggest geopolitical vulnerability. For you, the investor, the business owner, the financially curious citizen, this isn't some abstract debate. It means the world is becoming more complex. Currency risk is no longer just about the dollar versus the euro or the yen. A new, powerful variable is being added to the equation. The world's financial plumbing, which has been stable for 50 years, is slowly, quietly being rerouted, pipe by pipe. The dollar will remain the dominant force for the foreseeable future, but its dominance will no longer be absolute. The PBOC report from a few weeks ago wasn't just a report. It was a shot across the bow. A declaration that the game is changing. The real question isn't whether the yuan will win. It's how the world will function when there's more than one player who can afford to bankroll the game. That's all for today. Keep your eyes on the money, because it's on the move. Stay sharp.